Assalamu alaikum and welcome to a seminar today on financial planning tips. Thank you for joining me. My name is Faizal Karbani. Many of you probably have maybe talked to me. I know I've got some people I know joining today, so thank you for sparing the time. So hopefully what I would like to do today is share with you some financial planning tips, some guidance. We as human beings live in this world, and we have finance is a part of it. You know, we've got to live, we've got to eat, we've got to provide for our families, and whether we like it or not, money has to be handled and managed. And what I'm trying to do today is really share with you some tips and useful things where basically you can make your life easier. You can achieve those goals that you have in a more, I suppose, efficient way, in a less pain-free way. And as a financial advisor, over the years, I've learned that there is really some great merit in planning and, sort of really thinking about these things so that you can hopefully, achieve those goals. So what we're going to do is I've got a presentation and I'm going to go through that. What I want you guys to do is obviously the most important thing is that you benefit from the time you're giving here today. So if you have got questions, there is a chat box in the YouTube function, and you can jot those down. I'll probably take those questions at the end of the presentation so that we have enough time to get through the presentation, and then we have enough time to get through the questions as well. So I hope that's okay. So what I'm going to do with you in a second is to share with you a presentation, and I'll go through that with you. But just a couple of minutes about myself. So my name is Faizal, like I said. I founded Simply Ethical in 2009 with the intention of helping people achieve their financial goals without having to compromise their faith or their ethics. I'm alhamdulillah very blessed to have a really great team around me. We have 3 financial advisors, we have an investment manager, we have a head of marketing, and we have 2 people who are dedicated to serving clients. So we've got a nice little team. Alhamdulillah, it's a pleasure working in what we do and serving predominantly the Muslim population in this country, but we are open to everyone to come and try what we have to offer. And the Islamic principles are there for everyone. They're good for humanity. So that's what we're trying to hopefully promote over time. I'll just now share a presentation with you. So just give me a second. Okay. So you should now basically see the first slide, which is just a title slide. Just a little bit about Simply Ethical. Like I said, we were established in 2009. Our vision and aim is to help people achieve their financial goals without compromising their faith and ethics. And really, that was really very much due to my own journey and wanting to invest and save, but do it in a way where I didn't have to compromise my faith. We're directly authorized and regulated by the Financial Conduct Authority. Anything matters financial, and when it comes to financial advice and investment advice, is very highly regulated because, as you can probably appreciate, when it comes to money, there is a lot of people over the years, unfortunately, have been missold things or misdirected or misguided, and there's a lot of regulation to make sure that the advice we give people is appropriate for their circumstances and situation, etc. So we have to be authorized by the FCA to do what we do. So what we offer is basically financial advice, and what we started off in 2009 as offering financial advice on a face-to-face basis. And as the world has evolved, as you all know, in recent times, the internet is playing a massive role in our world, and a lot of financial services have moved online now. So we're no exception. We are now started offering in the last couple of years a online service for financial advice, and essentially the idea is that it's more suitable, excuse me, it's more suitable for people who want to invest relatively small amounts of money. They don't need an expensive financial advisor. So it's much more applicable for people who want to do regular savings, either in a pension or an ISA or something like that. We only deal with Sharia compliant solutions in the UK. So we as a business, we've committed ourselves to just dealing with Sharia compliant products. And the whole idea of the business was to help people with their financial planning and investments without them having to involve themselves in halal, haram stuff, basically. And alhamdulillah, over the last 10, 11 years, we've alhamdulillah got a good network of people we know in the Muslim community in the UK. And we've done outreach programs like seminars like this over the years. Mainly we've done them in person at venues across the country, but obviously with lockdown and the pandemic, these type of events online are becoming much more frequent and popular. Right, so what are we going to do today? We're basically, as the title of the seminar suggests, we're going to talk about financial tips and the importance of financial planning. I'll then touch on how Simply Ethical can help you with that journey of yours, and we'll have plenty of time for you to ask questions as well. So before I move into that, I mean, just for those of you who perhaps are not familiar with, the principles around Islamic finance, it's now becoming quite a big industry. It's still relatively small, but it's basically expanding at quite a fast pace, and it has done for the last 20 years or so. But essentially, this first slide is just really to give you some of the key principles. The first thing and the most important distinction, I suppose, from conventional finance is the one you see regarding the prohibition of riba. So riba is the word used in the Quran and is often translated as interest. And most scholars agree that it is any form of interest. So this is obviously something which is very prevalent in the financial system as we know it. And a lot of investments, a lot of assets, when you go and see if you want to invest in them, or when you want to buy something and to get finance, you may have to enter into contracts which involve riba. And so, a key thing that we have to work around is this prohibition, and to find investments or to find solutions which don't involve this or minimize the impact of riba. There's also the concept of halal and haram, obviously, in terms of the businesses that we can invest in or the assets we can invest in. So clearly we can't, invest in businesses involving alcohol or pork or anything like that. So we have to find halal businesses that will basically take the investment. Obviously, the whole faith-based approach is that it's basically based on ethical and moral values. So when it comes to this profit and loss sharing concept, basically in Islam, when a financier gives money or puts their money into some asset or business, they can't expect a return in terms of interest. So one very popular and very authentic way of Islamically authentic way of sharing that the fortunes of that business or the asset is through a profit and loss sharing agreement with the investor. And this is very much at the heart of Islamic finance. Clearly, there's a prohibition of gambling and the prohibition of speculation as well. So the prohibition of speculation really comes from the fact that God Almighty wants you to be responsible with the with how you use your resources or how you spend your money, and therefore, in terms of taking responsibility, whatever actions you do should be based on sound knowledge and research rather than just taking a chance, and therefore you may lose what you have. So that's very much where that principle comes from. Right now, this diagram on this slide really seeks to kind of just depict what an average person may go through in terms of the financial journey in life. Obviously, everyone starts off single, and as you start getting into an age where, late teens, etc., going to university, you might get your first part-time job, etc. You will start thinking about money, and people try to then save. People have various goals. Maybe it's initially just to save enough to go on holiday or something like that. But it then goes into things like you want to buy a house, you want to perhaps get married, start a family. But that sort of early phase is all about sort of accumulation of wealth and perhaps some protection as well. As you have a family, you might start thinking about school fees, university fees, and you have a bit more disposable income as you start working full time, etc. And you start thinking about, other goals in life, whether you want to, maybe as a Muslim, you might think going for Hajj these days, for example, is quite expensive and you might need to save for that. Or you might, like I say, want to buy a property. You might want to start saving for your children's school fees, university fees, etc. Or you might want to do an extension in the house or things like that. As you are then accumulating wealth, and later on in life, you start thinking about, okay, the distribution of that wealth and also your retirement years. So whilst you're working and income is coming in, it's fine, but you have to think about the day when you're going to stop working and when you're going to have to start building up something to support you in your retirement years. And as you'll see today, the sooner you can start thinking about these things, the better it is. And the sooner you start planning for these things, the easier it is. So this is a key theme of what I really want to get across today, is that financial planning can take a lot of the stress out of your financial journey in life. And this is something really sounds very simple to say, but the more I have gone through life and the more I have advised people and the more I've seen things, those who do start early, those who do have a level of financial discipline with their financial affairs, really do see the benefits of that, because they're not then scrambling around trying to, for example, get enough money together to support their child through university, or making some really very stressful decisions about maybe taking some extra finance on the house, because they have these savings that they have built up over the years to support these type of events. And retirement is definitely one of those where you have to think about that as well. So really, what I want to emphasize today is that, I used to think, and I used to be one of these people that used to think, focus on earning. And when it comes to financial planning and investing, I was very much of the view that, when I've got enough money, I'll think about investing, and I didn't really, in my early years or in my 20s, I didn't really pay much attention to investing or saving. But I now really feel that was a mistake, because what I should have done is I should have had the discipline to say, even £100 a month, if I had put that away and let that grow, and I'll show you some slides shortly, that could have really paid a lot of dividends by now, and you would have built up a nice nest egg in sort of 10, 20 years time. So that mindset of you need a lot of money to start planning and to start investing is actually a red herring. It's not that, it's actually not the right way of thinking about these things. It's better to actually work with what you have and actually do something rather than nothing, because it really does make a difference in the medium to long term. So, kind of, this is a very logical approach to sort of your financial planning. It's really to identify your goals. What do you want to do? You want to retire, obviously, in a certain way. You might think about, like I said, kids' university fees, other things that you might want to do, whether it's traveling, whether it's buying a second property, whatever it might be. You need to start thinking about, okay, how am I going to get there? So, it's identifying that financial goal. Then it's planning how much to invest, where to invest, and then make it tax efficient, so that you're not paying more than what you have to in terms of tax. So that's where choose an account comes in. So plan how much to invest. So, basically, like I said, it might be, for example, saving for children's education. Identify the sort of amount that you'll probably need. And then we work backwards and say, look, okay, how much do we need to save regularly and for how long? And this is the type of stuff a financial planner like us, a financial advisor, can help you with. And a lot of people are very capable actually of having, doing some basic work around this type of stuff. It's not rocket science, but it's actually taking the time to do it, which is more important. And you can start then really identifying what you need to do. So this is a very powerful example. I always felt that it really got to me when I first saw this. And so this is about university fee planning. Now, most of us, inshallah, with children, etc., will be thinking about this, or if you're in that position, or maybe you're joining and you've already had people go through university. Either way, the cost of university these days is quite significant. I mean, the cost, say, every year is approximately, say, £18,000, so £9,000 for the university fees, and then you've got the accommodation, living expenses, etc. on top. So over 3 years, a typical degree is 3 years, will cost you £54,000 per child. Now, this is quite a staggering, basically, table, in the sense that if you actually had the foresight to start saving for this and on behalf of your child from when they were born, basically you could only save up £127 a month. And if that grew at 7% per annum, after 18 years, you would accumulate actually £54,000, enough to pay for your child's education and university fees. If you delayed that by 5 years, you can see that goes up significantly, nearly £100 more, to £215. And this is a really, really key point, is that if you actually start thinking about things like this early enough and actually start taking some action, you can see, like, most of us probably wouldn't miss £127 a month. We might feel a little bit, and we might not be able to be so free with our money, but essentially we can probably all tighten our belts to not miss it too much. And it's not a huge amount of money, and yet you've achieved a major life goal of sending your kids to university without having to take a student loan out. And if I know lots of people who get to the point where the children go to university and they've got no provision for that, and it's quite a painful exercise, because the child ends up taking the maximum student loan, and the parents then really struggle to support their children, because to find another £9,000 a year to support your child through university is not easy for everyone. So you can see how, having that foresight and doing some basic financial planning can really, really pay dividends. Now, this is a really powerful example of what we call the power of compounding. And like I said, on the top of the slide, some call it the eighth wonder of the world, and you'll see why. So you have basically two investors, okay, exactly the same age, 25, and you have investor A, investor B. We assume they're going to get 8% return on their money, and you have investor A who has the foresight to basically invest for 10 years, €2,000. This was off I picked up this example off the internet, and the example was in euros. So basically, you have an investor A who invests €2,000 every year for 10 years. So in total, they've invested £20,000, okay, in 10 years. And every year, basically, they're getting 8% return. Now, the compounding bit comes into the fact that you don't take money out, but that 8% achieved in year one gives you a value of €2,160. You then add to that another £2,000 rather, And then by the end of that year, that 2,160 plus another 2,000 grows to 4,493. The point is the money is left in and the growth is then compounded by further growth. And what this investor does is basically for 10 years, he just invests 2,000 a year, making a total investment of 20,000 in terms of the outlay from him. And the money is left then to grow all the way till the age of 65. He doesn't take the money out, and the money grows to a staggering 291,234 euros, a whole profit of 271,234. Okay, and he has a lump sum at retirement of 291,234. So basically, he's got that lump sum. Now, the actual return that he's making on that is, you can see at the bottom. Sorry, let me just go back. Sorry about that. No. Apologies for that. I pressed stop share by mistake. Okay. So yeah, so apologies for that interruption there. But basically the money grew by 14.6 times from what the 20,000 euros the investor A put in. Now you have compared that to investor B. Investor B basically waits and doesn't make any investment until the age of 35. And then they basically put in 2,000, basically 2,000 a year in, euros in, but then they do that all the way from the age of 35 to the age of 65. Okay, so instead of investor A only invested for 10 years, but investor B invested for 30 years. And after 30 years, they have invested a total of 62,000. They actually invest for 31 years. They invest a total of 62,000 euros. And the total investment then tallies up to 266. The value of the investment tallies up to 266,427. Again, they haven't taken any money out. They've let the money grow and compound out. And their total return after 62,000 invested is a return of 4.3 times what they put in. You can see the massive difference between investor A and investor B. Investor A rather, has invested less than 1/3 of what investor B has. But in terms of the return on investment, they've made a return of over 3 times what investor B has. This is the power of compounding, and that this really comes down to the principles of investing early, letting the money grow and work for you, and actually having the patience to leave it without taking anything out or the minimum you can take out. And then you see the effect of that over a long-term period. In fact, I had a client the other day who was having a consultation with me and said, he worked out that if he invested at the age of 25, he invested 42,000 into a pension and let that grow at 10% per annum. By the time his retirement came around, that pension was worth £1 million. So this is the power of compounding. When you leave investments to grow for a long period of time, the investment grows and then the growth goes on top of that growth. And this is what we call compounding. And the secret lies in leaving the money in there to grow and work for you and starting early. You can see that investor A is hugely advantaged by the fact they started 10 years earlier and let that money then grow till the age of 65. So this is a key message that I want to get across today to everyone, is that whatever your situation and whatever your circumstances are, you may feel that, I don't really have a lot to invest. Like I said, even if you put £100 a month away, you could see the benefits of that. And especially the youngsters out there, the people are relatively young, you could really see the benefits of that in 10, 20, 30 years time. If you really have that discipline of doing that. So you're probably asking then, okay, you've got the appetite of investing perhaps a little bit now and doing something. So the question is, when it comes to kind of Sharia compliant investments, where do you invest the money? I'm sure it resonates with a lot of you in terms of our parents effectively often just invested in property because, that was something they could touch and feel. They understood that. They could see the prices go up. But other things such as shares or funds or whatever, it wasn't something that basically they had much knowledge of. It wasn't very accessible. And so certainly from a Sharia perspective, there was very little provision. And this is where, companies like ours basically are trying to change that so that, a lot of people have access to ISAs, pensions, financial advisors, but the Muslim community often, that wasn't something that came very natural to them for many reasons. But one of them was definitely the lack of provision in terms of Sharia compliant options in the market, etc. So this has been something that's changing over time in terms of what's available. We as a company, when we started in 2009, were working with a much smaller set of investments than we are today. Today, we have over 100 Sharia compliant investments. We have shares, which are often regarded as called equities. There's a lot of work around that, which you're going to go through today in terms of what are halal shares to invest in. Then there are things like exchange traded funds, which are very much like funds. You can think of them as collectives where lots of people invest into one pot, where there's an investment manager, and the investment manager sets a strategy of investment. So where they will decide, there may be, for example, there may be an emerging markets ETF or fund where they invest the money in companies in emerging markets, or there may be, funds which are dedicated to a particular sector. So you see there investment funds listed. You've got Sukuk funds, which again, some of you may have heard of, may not have heard of. Sometimes they're referred to as Islamic bonds. So this is a parallel we'll just draw quickly with the conventional sector. If you were to invest money in the conventional sector, non-Muslim sector, if you like, a key part of a portfolio of investments you might have would be bonds. Bonds are really interest-bearing investments. So either governments issue bonds or businesses issue bonds. And what they do, they promise to pay you a certain interest rate on the money you invest with them. And clearly, from an Islamic point of view, this is not halal. And so basically, from a kind of almost an alternative to that kind of investment, it's often referred to as a fixed income investment. And why they say fixed income is because when you get an interest rate, you know exactly what you're going to get, as opposed to investing in a company's shares, which, the value may go up and down. The dividends you get from that company may be up or down. There's not a fixed level of kind of return as such. And so people like sort of the conventional bonds because it gives them that safety net of predictable return. In the Islamic space, there is something called sukuks, which are often regarded as a kind of Islamic alternative to a fixed income investment. And the reason that they are regarded in that sense is that usually what a sukuk is some kind of investment where there's an underlying asset which is giving some sort of income. So the most basic example is where the sukuk effectively is an investment based on, for example, property, where there are properties in that sukuk, and that those properties, you effectively as an investor are investing in those properties, and those properties are paying a rental, for example. And so that fixed income side is coming through, for example, a rental stream. And so that's a key part of the kind of investments we use for a lot of our portfolios. There's usually a sukuk element to give that kind of fixed income side to the portfolio. And then there are equities, equity funds, property funds, and commodity funds. Commodity funds are generally precious metals. So we have funds and investments in gold, silver, and other precious metals, for example. So these are this is the kind of the world of Sharia compliant investments. This diagram effectively kind of just depicts the fact that these different type of investments, there's usually a kind of trade-off between the amount of risk you take and the rewards you might get in terms of return. Generally, a principle in investment is that the more risk you take, the more potential return you can probably get. And effectively, this pyramid starts at the bottom with those things which are regarded as very safe. So, you may have, for example, banks like Al Rayyan Bank and others, Islamic banks offering Islamic deposit accounts, and they tend to be very low risk, tend to give you a return which is fairly safe in terms of what you'll get. The Sukuk funds we've just talked about is kind of the next layer. Then you got things like property funds, again, often because of the rental income you'll get. And then equity and commodity funds are the next layer. And then private equity really refers to investing in private owned companies, not your blue chip companies listed on the stock exchange like Shell or Apple, but rather unquoted businesses where you don't know the owners, they're not listed on a stock exchange, but you may invest in a business like that. And that's regarded as relatively risky because you don't have the safeguards of the stock exchange and being in the public markets, etc. So when we try to invest the money for our clients, we try to give them a mix of assets so the portfolio is diversified. We also take into account how much risk the investor is willing to take, and we will try to measure that through a number of questions we'll ask, through questionnaires, etc., and trying to assess how much risk the client is prepared to take and should take in the sense that of their own financial situation and what their goals are, etc. So we will come up with a portfolio based on these different types of factors. Now, before we move on, I think, again, it's important to sort of just discuss, for a lot of you may come into this new, so how do people, how do we establish what is halal to invest in? A big part of Sharia compliant investing is investing in the stock market, in terms of, because what does the stock market represent? The stock market represents companies and businesses who are looking for investment, who are listed on the stock exchange where you can invest in. And, essentially, investing in businesses is perfectly fine. But what we have to do from an Islamic point of view, establish is two levels of criteria. One is a qualitative criteria. So is the industry that the business is involved in and the products they're selling, are they halal? So there are certain red flags and certain excluded sectors, and you can see them listed here: alcohol, tobacco, etc. So qualitative criteria is applied, and to screen out those companies which are not suitable to invest in. Now, it's not quite black and white sometimes, because you might have a business like Tesco's, which has a lot of halal products they sell, but they do also sell haram products like alcohol, etc. So the test that the basic rule there that the scholars have come up with is that you can screen out such companies to be such that if less than 5% of their turnover or their profits is derived from non-permissible sources, then you can potentially include that company in. But then it's to establish at the end of the year what return is from those haram sources, and then to give that return away. So an investor will, for example, be told that the return you're making on this company, give X amount away in charity to make sure you purify that investment. And we will do that on behalf of our clients anyway, in terms of the in terms of notifying the client of what that is, etc. In terms of purification, we will do that calculation. In terms of the quantitative criteria, the biggest one here, you've got certain ratios which the scholars have established. The main thing really is looking at the interest element. So the company, say, is a halal company. Let's say, I don't know, it manufactures tires or something like that, perfectly halal. They don't have haram sources of income, etc. But they may have some debt to finance the company, which is interest bearing. So basically here, the basic rule is that as long as less than 1/3 of the financing of the company is coming from interest-bearing debt, the scholars have allowed that leeway on the basis that essentially, Sharia compliant investing and in investing in the stock market is relatively new. There isn't a huge pool of companies which we don't have any kind of interest involvement, and therefore to say it is haram to invest in any company with any interest involvement would probably be not the right thing, because it would limit the investment choices for Muslims quite a lot. And secondly, they take a broader view of the fact that the stock market plays a very important role in the economy in terms of giving companies capital, giving companies the investment they need to employ people and take their businesses forward. And so they look at the sort of greater good that the stock market does. So they came up with this kind of tolerance level, if you like, with the caveat that over time that we should try to work to a higher level of compliance. And as Simply Ethical, where we invest directly into equities, we have taken the step of squeezing that ratio down to 20% currently. So these are companies we invest the money on behalf of clients into companies on the stock exchange. So our screening actually basically takes that down to 20%, and we're doing research to see if we can take that down further, and we want to try to push that boundary further down. But then you have these type of ratios which are there, and this area of Sharia compliant investing in equities is quite established and has been in the market for many years. So we have a number of funds. So you see in this slide here that you have 3 funds on the top, which are the HSB Islamic, a Global Equity Index Fund. You have the iShares MSCI World Islamic Fund, the iShares MSCI Emerging Markets Islamic Fund, or ETF rather. Now, I think the point, basically, these funds, the great thing about investing through these funds is that a lot of the hard work and heavy lifting is done in terms of screening the stocks, and they have a very broad range. Through these funds, we have exposure to over 700 companies. So you get lots of diversification through investing in these funds, and you can see the type of companies that are listed there where the money is invested. So the big ones: Microsoft, Apple, Facebook, Tesla, etc., Nestle, Procter & Gamble, Johnson & Johnson. These are household names, and you as an investor invest through these funds, and you get exposure to these companies, which is great. On the bottom, you have really this basically sukuk funds, and the names you see on them are less. You won't really know these names. Most people wouldn't, because these are sukuks which have been issued by companies in the main, and essentially the big companies have issued and raised a lot of money through. But they are rated. The fund managers of these different funds do their due diligence on these, and you have the ability to invest through these funds and have that sort of fixed income element to investing as well. This slide is just to really show you that you may be asking yourself the question, well, if I invest in a Sharia compliant way, am I sacrificing return versus investing in a non-Sharia compliant way? And the answer to that question is that years ago, when this was very new, that might have been the case. But more and more data is now being published to show that actually Sharia compliant investing is actually very competitive to compared to the sorry, again, I've done that. My apologies. I keep on pressing the stop sharing by mistake. Let me just go back to that. Okay, right. So you can see here the returns on the Sharia S&P Sharia 500 Sharia index compared to the conventional S&P 500, and actually the Sharia over 5 years outperformed on an average basis over 5 years the conventional index. So similarly, oh gosh, have I done this again? My approach. Okay. And then similarly with the 350 S&P 350 Sharia index compared to the conventional, you can see a very competitive performance there as well. So, you know, I can't say here categorically that you're going to get a better performance by going on the Sharia side, because statistically and mathematically, we have got a smaller universe of investments. And therefore one would expect a superior performance in the conventional space. But, you know, the data does show that the differential in performance is actually relatively small. And, you know, I, as a Muslim, you know, I do believe that there is the barakah is there, you know, to invest in the Sharia compliant way. Okay, so that's now giving you a perspective of, I think I've tried to get through two key messages so far. One is that the power of financial planning and investing regularly and saving, regardless of your you know, if you've got a lot of money or not, the sort of the act of sort of setting goals and working towards them as best as you can by saving early and in a disciplined way has real benefits. And I think that's where, you know, whoever you are, whatever situation you're in, you know, do take stock of that. Secondly, when it comes to Sharia compliant investments, I think you have hopefully a good idea of the type of investments which are out there. And, you know, there is a decent universe of investments out there, which is going to give you hopefully a decent return, not too far off what you would get if you were saving or investing in a non-Sharia compliant way. So hopefully those are two key messages. The third key area really is to talk about the tax side. And we've got the tax year end approaching as well, just in a couple of weeks. So basically, I think the tax efficient vehicles for investing are the three that are listed after the first one. The first one, there are just general investment accounts which we can provide, or anyone can provide, and they don't actually have any kind of tax benefit attached to them as such. They're just investment accounts, and you'll pay tax on the profit or the gains you make accordingly. But there are tax efficient vehicles to invest, and they've been set up by the government really to encourage people to save and invest. So you've got the ISA allowance, which we're going to discuss. You've got a way of saving for children in a tax efficient way, which is the junior ISA account, and you've got personal pensions as well. And they all come with their own tax benefits, and generally you're well advised to use these vehicles first and use the allowances you get every year before you go and invest in a general account without any tax benefits. Let's just have a quick look at what these are then. So in terms of the stocks and shares ISA, you get an allowance of £20,000 every tax year. And basically, the benefit of this is that it's free from UK income and capital gains taxes. So what this basically means that every year, every tax year, you can invest £20,000 in investments which are eligible to be in an ISA. And not everything is, but generally everything we offer generally is. And essentially any profit you make or any income you get from those investments is free from any kind of tax in terms of income and capital gains taxes, and you don't even have to declare it on your tax return. So this is a key basically benefit, and everyone, like I said, every adult in this country gets this £20,000 allowance every year. Once you have that allowance, you can't, if you're not used all of it, you can't carry forward an unused element of that. You just basically get that £20,000 every tax year. If you use it, you use it. If you don't use it, that's it, it's gone then. Basically, every person has their allowance. So as a couple, you could, for example, save £40,000 into ISAs, 2 different ISAs every year. And basically, a lot of people maybe watching today or having hearing this may have ISAs from previous times or previous years. That can be transferred into an ISA. For example, if you set one up with Simply Ethical, the previous ISAs can be transferred into the ISA with Simply Ethical, but it doesn't count towards your ISA limit. So you could have, I don't know, 40, 50, 60,000 pounds accumulated from previous ISAs that can be transferred into an ISA with us, and then you still have your £20,000 limit for the year in terms of investments for this particular tax year. Given that we're so close now to the tax year end, that we're saying anyone who wants to basically set up or contribute to an ISA for 2020, for the tax year ending 5th of April 2021, the funds need to be with us by the close of play on the 30th of March, because as you're probably aware, the 1st of April is Thursday, and then Good Friday falls on the 2nd, and then we hit the bank holiday weekend. So you pretty much then after the bank holiday weekend, you've effectively run out this tax year. So basically, this is the most basic way to invest in a tax efficient way. So everyone should use the ISA allowance before they basically invest through a general account or something like that. Yeah. Basically, in terms of children's savings, there used to be things like the Child Trust Fund, etc. That's all been replaced by something now called the Junior ISA, and the limit here is £9,000. It's basically money that effectively belongs to the child, and you can't make any withdrawals from this Junior ISA until the age of 18. And at the age of 18, it automatically converts into an adult ISA. Basically, a lot of people want to ring fence money for their children, for their university fees, etc. And again, the whole idea here is that the growth is tax-free, and you can have something in the name of your child, and you basically can save in a tax-efficient way. Like I said, the limit is £9,000 a year, and effectively, there is something called the annual gift exemption of £3,000. So normally, when you give a gift to someone, you basically it may count towards your inheritance tax, in terms of the fact that if you die within 7 years, they may look at the gifts you've given in the last 7 years and total those up to include those as part of your estate. But there is this exemption of £3,000 a year, which you can give basically without that counting towards your inheritance tax estate, if you like. And there is also this provision of gifts out of income. If they basically are making regular payments out of income, which don't affect your standard of living, then they're also normally exempt from IHT. So there's just a little small planning thing there in terms of, if you are worried about inheritance tax, it is a way of taking money out of your estate and giving it to your child, or it could be someone else, like an uncle or an aunt or someone making a contribution on behalf of that child. Right. So in terms of sort of regular saving, regular investment, you should consider an ISA, and for your children, a Junior ISA. The great thing about these vehicles is that there's no, apart from Junior ISA, you can't take the money till 18, but for an adult ISA, you can invest and you can take the money out whenever you want. So it's very freely accessible. When it comes to pensions, there is greater tax benefits, if you like, attached to pensions, but it comes with the kind of the restriction that you can't touch that money until the age of 55. And that's the real difference between an ISA and a pension. So a pension is specifically designed to help you prepare for your retirement. And the idea here is that basically whatever you put into a pension, again, doesn't attract any tax in terms of the growth you're experiencing within that pension. But importantly, basically, you get tax relief on your contribution. And I'll show you a slide next in terms of how that tax relief works. But this is something you don't get in an ISA. You don't get relief on your contribution. But to encourage people to put money into a pension, the government actually gives you tax relief on what you put into a pension. And I'll explain what that is. But it's very generous benefit that you're getting through putting in money into a pension. And the reason the government has done that is because we're facing a situation where the population is aging. The government pension itself, the state pension, is not going to be, it can be about £9,000 a year. But if you think about the amount of money you need to support yourself in retirement, you'll need more than £9,000 a year to live in a comfortable way. So they really want to encourage people to save for their retirement, and pensions is the way they're trying to do that. As you all probably aware, that the workplace pension has been introduced, where it's now mandatory for every employer to have a pension for their employees, and also to contribute on that pension for the employees. So it's all part of the planning to get people saving for their retirement. Basically, I won't dwell too much on this slide, but you have the state pension, and then you have non-state pensions, which can be, like I said, occupational or workplace schemes that your employer has set up for you. And then you can have your personal pensions, which are the last three types of personal pensions that you can have. At Simply Ethical, we basically offer a self-invested personal pension, which is effectively just a different kind of personal pension, where you have the flexibility to invest in what you want to invest in, as long as those investments are eligible for pensions. The basic rules around pensions that you can access your money at the age of 55. You have the ability to put in. If you're not working, you can put in 3,600, or if you are working, it's 100% of your annual income up to a maximum of £40,000. Basically, the annual allowance can also be affected if you're earning over £150,000. So that would be basically reduced accordingly. And there's a lifetime allowance of over £1 million now of what you can accumulate into your pension. So what makes a pension Sharia compliant? And this is what you have to slightly be careful about. Those of you who've got workplace pensions, you should ask where the money is being invested. That's probably the most key difference. A lot of workplace pensions do generally have at least one Sharia compliant option, and the government has set up an investment option for employers to set up a pension scheme with them through the Nest program, and they also have a Sharia compliant option. So if you don't know or you're not sure, you should ask your employer about what are the Sharia compliant options, investment options you have for your pension, and usually there is at least one. The problem is they only provide one fund, which is very limiting in terms of investment diversification, and is not really something that we would recommend, because you're putting your eggs in one fund effectively. You're not getting diversification across different assets or different funds, etc. So it's very limiting in that sense, but that's the main thing that you have to watch out, because essentially a pension is just a pot. It's a tax wrapper. It's what you put into that pot which makes it Sharia compliant or not. The other thing that you have to be wary of is that a normal pension may have some interest involvement, in terms of there's cash usually sitting there alongside investments, and that cash might be attracting interest. So you have to be careful of that. And if interest is paid, you got to take care to try to take that interest out by giving away in charity or something like that. Basically, also when it comes to taking benefits from the pension, scholars are not keen, or they don't regard. You may see an option when you take a pension of annuity. Annuity means that, let's say, for example, you have a pot of 250,000 in your pot when you retire. One of the options they will give you is to say that £250,000 can buy you a certain amount of income every year, and it can be guaranteed for you, and that's called an annuity. Now, the scholars are not comfortable with that, because basically that annuity is usually on the back of some kind of investment in some sort of interest-bearing bond or something like that, number one. So there's usually some kind of involvement of interest, and secondly, basically that kind of the return you're going to get from that annuity is also because you don't know how long you're going to live for, it is uncertain. So basically the scholars say, look, that the whole sort of arrangement of annuity is something that they don't consider to be Sharia compliant, and they'd rather you invest the money and then get your return accordingly based on the investment returns you get, and therefore basically the most sort of Sharia compliant option that most of our clients, almost everyone, takes when they draw their pension is something called flexi drawdown, where effectively the money is invested and you take out from the pot as and when you want to, and that's regarded as Sharia compliant. And then when you leave your money in your pension, it's important that you take into account the inheritance laws around Sharia distribution. So you have the ability to express that accordingly and to make that whole pension arrangement Sharia compliant. The tax relief on pensions, which I mentioned, which is really important, is that when you set up, for example, and this is a really key point to take into account, the type of pensions we offer, if you set up a private pension with us, a self-invested personal pension, a SIP, the way the tax relief works is that for every £80 you put in, the government puts another £20 in. Put simply, whatever you put in, the government tops it up by 25%. And this is something to just to reflect on for a second, because effectively there's no other vehicle that gives you a guaranteed 25% return on day one, effectively, of your investment, guaranteed by the government. Now, to get 25% on an investment, you probably have to wait 2 years, 3 years before you get 25%. This is something the government's giving you in terms of topping up whatever you put into a pension on day one, effectively. I mean, you have to go through a process of claiming the tax relief. It takes a few weeks usually to come through, but effectively, you've got that at the beginning of your investment. You're getting that 25% uplift. As a basic rate taxpayer gets that. It gets even better if you're a higher rate taxpayer. Basically, as a higher rate taxpayer, then what you can do when it comes to filling in your tax return, you've got that extra lift of 25% up, but you can claim another £20 tax relief effectively when you fill in your tax return by saying that you made X amount of contribution into a personal pension, and they will take that, give you that extra 20% off in terms of your tax return, in terms of a tax deduction from whatever tax you're due to pay. And if you're a top rate taxpayer earning more than £150,000 a year, then you get 45% relief rather than 40%. So it's a very tax efficient way of saving. The drawback, like I say, is that you can't touch the money till 55. And when you do take the money out, the first 25% you can take out from whatever you have in the pot is tax free. But thereafter, whatever you take out will be treated as income, as if you were earning income, and it will be taxed on the way out. So there is that nuance there as well. For ISAs, you're not given tax relief on the way in, but you're not taxed also on the way out. With pensions, you are given tax relief on the way in, and then there is this generous 25% tax free, but the remainder is taxed at whatever rate of tax you pay at the time of you drawing your pension. So it is not completely tax free, but it is very advantageous to save in this way. Yeah. Now, the point I'm going to make on the next slide is really the same point I was making earlier on about the importance of doing this early enough. If you basically, we got an example here of a person who's aged 30 and they have the ability to save £1,000 per month, and effectively to the age of 65, they said, so for 35 years they're going to do that. Now, if they did that, their portfolio would be worth £1.45 million. Look at the difference if they basically delayed that by 5 years. It's a staggering difference of almost £440,000 difference. In their portfolio would be worth 1 million, right? If they delayed by even just 1 year, the portfolio would be worth less than by 100,000 less. And even by 3 months, they're losing out on 30,000. So the compounding effect of investing in for a long period of time is amazing here, and something that your retirement and your pension may be something you think is far too far in the future. I don't have to worry about that. I've got other things to worry about, putting the kids through university or whatever it might be. But again, it comes down to, if you have the discipline of actually, doing this, in a way where you can put some money aside. So when you're financial planning, you probably want to break it down into short, medium term, and long term goals. This will come into the long term usually, but you can effectively, if you have the discipline and the foresight to do this, then by putting aside money earlier on, it means that your retirement years you can really benefit from a nice pension and a nice income. Yeah. So we're coming to, we've done just about an hour, and I'm keen to get into the questions quite quickly, but just a couple of quick things. If those of you are earning £100,000 plus, you'll probably realize that for every £2 you earn above £100,000, you lose £1 of your personal allowance. So by the time you get to 125,000, you've lost basically your personal allowance completely. Now, a tax efficient way of sort of mitigating that loss of personal allowance is to put money into a pension, because basically, if you put your monies into a pension, then they don't taper away this personal allowance. They look at the post pension contribution amount. So if you're earning, say, 120,000 pounds, and you put 20,000 into a pension, you can safeguard all of your personal allowance. And you can see here that basically you can basically get an income tax saving of up to 60% by doing that. So if you're earning over the 100,000, it's worth dwelling on that. And by all means, one of the things I was going to say today was that we've got something on our website which you can book a free 15-minute free consultation with one of our advisors, basically. And this is the sort of thing we can discuss with you if you want, and really help you through this and think through this. But it can be very, very beneficial. And then effectively, for those of you who have got limited companies, you are probably taking money out through a dividend payout. And you can see from the example that if you are effectively taking dividends out, initially you would have to pay corporation tax on whatever the company makes in terms of profit, and then so basically, if you were making a £10,000 profit, you pay 19% corporation tax, 1,900, and then you effectively may want to take dividends out after that, and then you pay an additional amount of tax. So there's an effective tax rate of 45.3% you'll pay in total, because the dividends attracts a rate of tax of 32.5%. So on the 8,100 that you have after you've paid corporation tax, you pay that amount of tax. And so in total, by the time you've got the money in your pocket, you've paid a total amount of tax of 45.3%. Now, if you effectively put money into a pension as an employer on behalf of an employee, that is corporation tax deductible. And so effectively you could put that £10,000 into a pension for you as the beneficiary of that pension, and that saves you the corporation tax. And obviously then the money in the pension belongs to you, and you have certain rules around when you can take the money out basically from the pension. But if it's something that you from a cash flow perspective, you're happy to put that into a pension, let that money grow for you in a pension, then you could save yourself a lot of tax by doing that. Yeah. So effectively, just want to talk about how we can help you in this, in sort of achieving your financial goals and doing some of the things that we've talked about. So we have this online system, and I would urge you, if you get a few minutes, to go onto our website, simplyethical.com, and basically have a look at the online system. You can set up an ISA, you can set up a pension or a general investment account, and it takes about 10 minutes to go through this online process. It seeks to ask you certain questions about the amount of risk you're prepared to take, your financial knowledge, how long you want to invest for, etc. And then at the end of that journey, it will effectively recommend a portfolio of investment for you, which is a diversified, balanced portfolio, and takes into account the answers you've given. Now, we've designed 7 model portfolios from ranging from low risk to relatively high risk. And effectively, you will be recommended a portfolio which is suitable for you. And then there's some flexibility in you going up one risk level higher or one risk level lower. But essentially, the great thing about the online option we have is that it's no setup fees. There's no initial fee or anything like that. It's very cost effective and it's very quick. So, for that sort of regular saving, £200, £300, £500, etc., a month or whatever, it's very, very effective. And you get a professionally designed investment portfolio which we manage for you, and all the heavy lifting is done for you. For those who have got more complex financial planning needs, or have got more money to invest, then it's probably worth taking the time to speak to us as on a personal level, because for more complex needs, you probably need more bespoke advice, and for larger sums of money, there are probably enhancements we can make to the portfolio beyond just the model portfolios, because then we have the ability to invest directly in, for example, in shares, etc. For lower amounts of money, we just tend to invest in funds because they give you that diversification that you need, and there isn't really the scope to invest directly in shares for small amounts of money. So, like I said, go online, have a look at that simplified advice online. You'll see screenshots like this. It'll take you through a process. You'll get, your own dashboard where you can look at your investment performance, etc., and you can get certain reports, etc., which will help you financially plan. We have set our fees to be very, very competitive. So we've benchmarked ourselves against other players in the market which are offering Sharia compliant investments, but also the conventional players. And our kind of principle is that we don't want Muslims to pay more for going to a Sharia compliant business than what they need to versus a conventional player. So we haven't put a premium on the fact that we're Sharia compliant, and we try to make the fees very, very competitive. So you can see our fees compared to the others in the market. And so lastly, this online platform is a great way of sort of consolidating accounts. You may have pensions from previous employers, for example. You can get that all into one pot with us and be investing in a Sharia compliant portfolio. So it makes sure it's in one place. The charges are very competitive, and you have a fully Sharia compliant solution. Similarly with ISAs, you can get ISAs that you've had previously and put them into one pot. So this is a great opportunity with the online platform. And really, like I said, with the financial advice, it's more, for more bespoke planning, which is really requires that kind of individual tailoring and understanding of your circumstances, and to come up with a plan which is suitable for you. And by the way, we've recently done some financial planning, for example, for clients who don't need an investment solution, just need someone to give them guidance on their financial planning and come up with a plan. So it doesn't have to be investment led. We can advise you just on your financial planning, etc., and getting your affairs in a more, I would say, more efficient and tax efficient way. So yeah, there's a process we go through for that in terms of understanding your needs, research and analysis, and then presenting the recommendations, and then agreeing those with you, and then the ongoing monitoring and support. So that's really the presentation. I just basically, I'll now stop sharing. There's our contact details there. The easiest way is to get onto our website, simplyethical.com, and you'll see all the information there. Okay, guys, thank you very much. That's basically great. I can see, basically, I can see some questions that have already come through. So I'm happy to try to answer those. Yeah, so Luqman, what are your thoughts on cryptocurrency from a Sharia perspective? That's an interesting question, and it's very much in the news at the moment, and we keep on hearing about this. My own personal journey with cryptocurrency, that when it first came out, I did spend some time looking into it, and I didn't fully understand it, to be totally honest with you. And so therefore, my principle is, if I don't fully understand something, I keep away from it. But obviously things have developed, and with cryptocurrencies now, a bigger picture with blockchain, etc. Now, I totally buy into blockchain and the revolutionary nature of blockchain. With cryptocurrency, I'm still, the jury's out with me in terms of the confidence I have to invest in. As a company, we've also taken the view that we will not be investing in cryptocurrency, mainly because, firstly, there's an understanding issue. Secondly, everything we do has to be regulated, because we're regulated by the FCA and we're dealing with the retail public. So, but I can tell you that I can refer you to, if you look at Mufti Faraz Adam, he's our Sharia advisor. He's written extensively on cryptocurrency, and his views are very balanced in my view. So I think definitely there is scope to invest from a Sharia perspective. It's not a complete no-no, because I know that much from talking and reading so far. So it's definitely an area, if you're interested in, I would recommend Mufti Faraz Adam. He's got a lot of stuff online. If you're still getting stuck, I can see if I can put you in touch, or at least for you to give me your questions and I can go to him. But yeah, there's definitely mileage in investing in cryptocurrency. Right, next question. What is the situation with Zakat and pension fund? Is Zakat only payable on the fund balance once it is crystallized? Okay, very, very interesting question. It's come up a lot in our time in doing our work. And National Zakat Foundation has looked at this 2 or 3 times, even in recent history, because I think the challenge with pensions is that you can't access the money till 55, but yet the position, and even the position now, is that you should try to pay on the normal money purchase schemes. You should try to pay zakat on that every year, regardless of the fact that you can't get access to the money, or it's not crystallized. And the understanding there is very much based on the fact that it's regarded as your asset, and therefore, and which you have effectively set up, and therefore it is your money effectively, and therefore the zakat position is that you should try to pay. Now, I've actually talked to people who say, look, I just don't have access to the money. I don't have the money outside of the pension to pay the zakat, in which case zakat was never supposed to be a burden. It's supposed to be something that the rich are able to contribute to the poor. And the Mufti Faraz's view is really just pay what you can, such that you don't put yourself in financial difficulty. And then when you have the means to pay, when you crystallize the pension, access the pension, or you have other means, then you can make up the shortfall later down the line. But basically, that is the kind of the position that Mufti Faraz is very much said, and I've had extensive discussions on this. So I hope that answers your question. But if you want some sort of chapter and verse on it, then please do go to National Zakat Foundation website, because they have got specific articles, etc. on this. Yeah. Right. Any other questions, guys? Please don't feel shy. We've still got 15 minutes or so, which we can use. If you don't have any other questions, that's absolutely fine. I mean, I think the kind of I hope first and foremost it's been useful. Right. So let me see. If you only have 10K on your pension annual allowance and income is example 140K, then best how to reduce tax by using a pension. Okay, so obviously in this situation, you are limited in what you can do, right? Because you've only got the ability to put 10K in your pension, which is going to mitigate your tax by 40% of that 10K. So you'll save 4K on tax by putting money into a pension. But beyond that, in terms of using the pension to mitigate your income tax is difficult, because you have this allowance that you are stuck with. Yeah, I mean, apart from, if that income is obviously solely in your name, often if you're in a limited company, etc., then you have the ability to, for example, get your spouse involved in a pension. I mean, in employment in the company, for example, and then they have their own pension, kind of allowance, etc. But if it's purely your income, then you are limited by that 10K. I don't think there is a way of kind of enhancing that further if you are hitting your limits. Yeah. Yeah, what I was going to say was that, look, okay, so this is Zakir Gara. I have a pension pot with you. What is the figure you provide me? Okay, each Ramadan. So yeah, so Zakir, assalamu alaikum. So yeah, it basically every Ramadan we try to work out the zakat on your basically portfolio, and we effectively have our data of what the investments are, what the rules are for different investments, because the zakat attributable, for example, to a sukuk fund, it will be different to zakat basically attributable to an equity fund, etc. And we work that out, and we'll be on that actually very soon now. And we try to get that to people by the middle of Ramadan at the latest, because we know people want to give their zakat in Ramadan. So usually at the start of Ramadan, we start working on it fairly soon in the first week, and then usually takes us about a week to get all the data and all the calculations done. And then we send that out. Yeah. Stuart, is it best to invest both in a pension and ISA for your retirement? That's a good question. So pension is obviously the obvious vehicle which has been set up by the government to help people invest for their pension. The ISA is if you are so basically if you are hitting your pension limits and you still want to save further for your retirement, then the ISA is nothing to stop you putting money into an ISA and to build it for the long term. So you don't get the 25% uplift or the tax relief on a pension, but by the same token, you don't get taxed on the gains. It's a very tax efficient vehicle to invest and save money for whatever reason, whether it's retirement, for for building, for buying a house in the future, or whatever it might be, kids' education. It's a very efficient way of saving. So yeah, I think pension would be your first port of call, but the ISA gives you more flexibility in terms of when you can draw the money, but it can, be done with one eye on the on retirement income as well. Okay, guys. So feel free still, if anyone else got any questions, feel free. But I was going to say that I hope it's been useful. What I really wanted to impart, and genuinely, was that the power of financial planning, the power of regularly investing and saving. And I say again, you don't need to be, someone with lots of money in the bank, on, making lots of money every month. You can have a reasonable income, a modest income, and you can still put a little bit away every month. But the power of that over time is amazing. And it can really make your life a lot easier in terms of, that the outlays you're going to have in your life later down the line. And even, having having a deposit for a house in the future, or whatever it might be. Yeah, so can you provide any advice on how student fees can be funded in a halal way? Now, I know the government, I was actually privy to some meetings on this as well, was very much, looking to come up with a Sharia compliant alternative to the student loan. And I can actually tell you that they put a kind of they put it out there for a company or an individual to put themselves forward to help with that and apply to be basically working with the government on this. And I actually applied for that a few years ago to say, look, my company can help with coming up with a solution. It actually went to another organization which was much bigger, and they got a part of funding from the government to really help come up with a solution. So the government was very much committed to coming up with a Sharia compliant alternative to this. Yeah. And I think they still want to do that, but unfortunately they haven't got there yet. So nothing's in the public domain in terms of Sharia compliant alternative. In the meanwhile, it's a very tough one. I mean, if you've got no alternative to getting halal finance for funding university fees, etc., then you may have to rely on the conventional student loan and that can be justified on the basis of necessity, darura. There's no other alternative for you. Your education is important. You want to go to university to study a certain discipline, and you've got no alternative. So therefore, on that basis, inshallah, Allah is forgiving, and you will be fine. But it's a tough one. There isn't really another alternative. I mean, unless you're lucky enough to have friends and family who can help you, but that's a difficult one. Yeah. Okay, guys. So, okay. Yeah. So there you go. The message that's come up is, please do go online, book a free consultation. We are doing this for now. We're going to see how we can cope with it. But the idea is that by giving you a free session with one of our advisors, we can give you some good guidance and help, and point you in the right direction. Yeah. Okay. With the current pandemic, what has happened to Islamic investments? Did they fall in value? I can answer this quite knowledgeably because almost every day we do reviews, or not, very regularly we do reviews with our clients looking at the investment portfolios. In fact, this afternoon I was doing one with our investment manager, Stuart, and basically we discussed this very point. So what you see in most graphs, if you look at the investment performance, is that Q1 of 2020, when the pandemic initially hit, the markets did panic. There was quite a sharp drop-off in values and investments. But alhamdulillah, what we've seen with our portfolios and probably more generally in the market is that there has been a recovery, and now the recovery, most of our portfolios are seeing good positive growth beyond just recovering from where they were. So alhamdulillah, there was a very sort of wobbly patch there, which we expect, but we've come through the other end, alhamdulillah. Yeah, so very pleased about that. And like I said, Islamic investments are not faring any worse than conventional investments from the knowledge and the data I have. Yeah. So guys, look, I'll kind of wrap up. What I would say is that I hope you found it useful, number one. Number two, genuinely, this is not a sales pitch. You can invest with us, you can invest with someone else. It doesn't really matter. What matters is that you take on board the importance of kind of taking some time, looking at what you want to do, how you want, what do you want to achieve financially, and then setting up some action, some savings, some regular discipline in that, in terms of achieving that, because that can really take a lot of the pain out of later down the line when you have to sort of shell out for various things, and it just makes your quality of life a lot better. So I would say that's really key. Secondly, I would say is that if you're one of those people who hasn't really done much, hasn't got much set up, the online solution we have is an ideal way to start. It's basically easy, it's cost effective, it's straightforward, and we do pretty much all the heavy lifting in terms of investment management, etc. And you can just sit back and really, after you've done a bit of initial work setting these things up, sit back and enjoy that and really forget about it to an extent in terms of things are happening in the background. You can set up direct debits, the investments are done for you. You've got 24/7 access to the system all the time to check how things are moving, going. You can get in touch with us if you've got any queries, etc. So it's a very, very good system for those type of people. If you're one of those people that has got more complex financial affairs or just needs help really untangling their finances, having a clear plan, then that's also something which we can help with, and we can run some financial sessions, planning sessions with you. We can be quite flexible in how we can even charge an hourly rate if required, for just giving you a few hours help, and that's sometimes all you need. So basically, there's a lot of flexibility in how we can help you, and I would just say take stock of that, and it'd be really interesting to get your views on how you found today's presentation. It's the first one we've done for a while, especially online. I'd be very interested to hear, did you find the content good? Secondly, and useful. Secondly, is it the duration? Is it too long? Is it too short? If you like, what else you'd like to see covered, etc. Yeah. So if you can share some feedback with us by emailing us, getting in touch, that would be great. But yeah, please do spread the word. Do look at our website, and if you like to avail yourself of that free consultation, please do book up on that. But I would say thank you very much for your time, and we look forward to hearing from you and seeing you in the future. Yeah, thank you.